Well, if only we could time the market, that is, in other words, sell at the top and buy at the bottom in some consistent way, we'd be rich beyond the dreams of avarice. You can only win in the market by disagreeing with the market, but the market is well informed. So I would say time in the market. That's the essence of it. And investors left to their own devices, without advice, tend to make terrible mistakes, much more inclined to buy at the top and in fact sell at the bottom. In other words, to play the momentum.
Obviously, the longer time you spend in the market, the better you're going to do. But there is an element of timing, because if you buy any index or any investment a week before it crashes 40%, so for example, it was worth $100, it drops to $60, and then it moves up 40%, it means it only goes up by 25%, so that takes you from 60 to 85. So you've lost 15%. And that takes a long time to make your money back before you have a return. So if you were to phase it in, so for example, if you have a long-term plan, to say every quarter you're going to put $1,000 into the market, then timing is not so important, because you are going into a phased approach. However, if you have one call and you have a big amount and you say, I'm going into the market, it doesn't matter the timing, because you'll get your money back, I think that's quite risky.
A lot depends on how much time you have as an investor, and as we always say to investors, the longer your time horizon, the more relaxed that you can be. There's data going back on the UK stock market to the 1890s, which shows that as long as you're willing to stay in for a 22-year period on that basis, you've never failed to make a positive real return by holding equities over that period. But obviously within that time span there have been odd periods when you have lost money. But the same cannot be said of bonds or of cash. And the reason for that is that equities are real assets, and they are exposed to the real economy, so they will be able to ride out the vagaries of inflation, particularly over the longer term, whereas obviously cash and bonds, other than index-linked bonds, are nominal assets.
Say you've got a pension plan and you're cashing in on the 31st of December 2018. Now the market may well be down 31st December 2018. And that could have a material impact on your wealth, on retirement. So then you've got to be very cautious. I mean, leading up to that, you really don't want to take a lot of equity risk, and equities being more volatile. You'd move your portfolio towards more cash, depending on your timing consideration. So that's why when you give financial advice, you want to know the circumstances of the individual. How exposed are they to time?
I think generally it's always about time in the market. Markets typically go up over time, and to time the entry points and the exit points in a particular cycle is almost impossible. And the majority of the gains are actually made in the first part of a bull market and right at the end. So you'd be much better off in general just to sit through the market cycles, and that would be a better way of capturing the upside. Although you'll get some of the downside, the time in the market will mean that your return in general will be much higher. However, there is a bit of a nuance to this, in depending on what you do as an investor. For example, we run multi-manager or fund of funds portfolios. In that particular instance, I think it's very important that one has a macroeconomic understanding and can form an idea of which tailwinds or what tailwinds are prevalent at a particular point in time, understanding the macros and the macroeconomic variables. This will then help us to allocate between various styles and asset classes. So for people running multi-asset portfolios, I think time is very important, but timing your entry point into risk assets versus insurance assets becomes a key consideration.
The problem that a lot of individual investors have is the psychology of markets and the timing, tending to herd in at the top and to be frightened out at the bottom. Another study was done going back 25 years on investors in the US, showing that cumulatively people who run their own portfolios on average lose 2% a year relative to the S&P 500. So that's just leaving money behind, which you cannot, just by being in an index fund, you'd be better than that. Yeah. But the problem is that we as humans have these behavioral traits and fallacies and problems that we have because we're human.
Momentum. The trend, you've all heard the trend is your friend. Well, the trend is very dangerous. It doesn't continue. And momentum investing is the kind of stuff that leads you to buy when prices have been rising and sell when prices have been falling. And that doesn't work. It turns around against you. Bitcoin being a very obvious recent example. People were buying Bitcoin because it was rising in price. They didn't understand why. And then, of course, it stops rising for good economic reasons. And then you're in trouble. So there's no easy way. So, and momentum investing is very dangerous stuff.
It's impossible to time markets perfectly, particularly every single undulation that you tend to get. But if you have a lot of time in the market, what hopefully that brings is experience, so that you can often spot some of the turning points in markets which make investment that much more valuable.